So thank you all once again for joining us on this evening. My name is Balram. We are from Spectrum Auditing, Spectrum Accounting, and SBC Tax Consulting. Along with me, I have Girish, CA Girish, who is also going to be part of this presenters. So the basic objective of this webinar is just to understand little basics of the taxes, but more than that, we want to focus more on the corporate tax return. So what are the challenges that we come across before? How do we well prepare ourselves before we start filing the return? And what are the challenges that we have as part of the returns that we have to file? And then what are the areas, some of the areas where you have to focus yourself to be able to address the, some of the common areas of or risky areas of identified for verification of our audit scrutiny, and what are the red flags that we have, and what are the common myths that we have, which are not true all the ways, all the times. So these are the basic, primarily this is what we want to cover. The more focus will be on the returns that we have to file. We will take you through some of the screens of the corporate tax returns and some of the fields which are not straightforward, where the information and understanding of the information expected to fill in those are not so straightforward, which may have some connection to other information, which you have to be very careful and make sure that all the numbers that you provide do talk to each other, they reconcile to each other, not only with the numbers that you provide as part of corporate tax return that you file, but also the numbers that you've incorporated in other filings that you have done. Some things like value-added tax returns that you file, customs records or documentation that you have, excise tax if you have excise tax returns applicability, audit reports that you submit as part of the corporate tax returns, as well as the audit reports that you submit to your license issuing authorities. All these numbers, all these reports, whatever you submit with all the government authorities, as well as, of course, the books of accounts that you maintain, all these should be reconciled. They should talk to each other. There should not be any gaps. If you have any numbers, if you have any differences in the numbers in all these reports, you should have a basis, or you should have a reason as to why they are different, and you should have a reconciliation to explain that difference. So these are the important areas that we want to focus more on. And basics of the corporate tax law, I'm sure most of you know it, but just to cover on some of the important key areas, just to understand who all are taxable persons as per the corporate tax law in UAE and who are not. So if you see the companies and individuals who are considered as residents for corporate tax purpose are the entities, all the entities which are incorporated in UAE, be it in mainland or be it in free zones, all of them are considered as residents for tax purposes. So there's no exception to it. Uh, Only thing that you have to look at is that what kind of license is it. Other than the sole establishments, everything else fall under this category, which means irrespective of your turnover, irrespective whether you're making profit or loss, whether you have started your business or not, as long as your license is here incorporated either in mainland or free zone, you are expected to register your company for corporate tax purpose and file the return. So some instances we come across where the business people think that since they don't have any business that they have done on that license, they think that corporate tax return is not filing is not applicable to them. So yeah, that is something that everyone needs to look at it, whether it is active, not active, whether you do business or do not do business, whether you have profit or not on those licenses. You are expected to register your company for corporate tax purposes and file the returns. The companies which are incorporated outside of UAE, which are non-resident companies, but if those companies are controlled or managed effectively from UAE, the business owner of that company resides in UAE and he does operate, control, and manage that particular outside UAE company from UAE, that becomes a resident company or resident person for tax purposes in UAE. which means the entire business of that particular outside UAE company becomes subject to tax in UAE, and you're expected to register and file return for that company in UAE as if that company is a resident company in UAE, incorporated in UAE. So that is a consequence of managing or running or controlling your businesses outside UAE from UAE. You need to make sure that you have good amount of team sitting outside UAE, and the owner also is traveling to that particular country or going outside UAE and managing, taking the strategic decisions and all those things from outside UAE. Yeah, so in the case of individuals, natural persons, generally any income that you have, which is in the nature of salary income or investment income or income from real estate, although that income which is in the nature or capacity of an individual, that is not subject to tax. There is no tax on that. But however, as an individual, if you are conducting any business activity, so in that case, you need to see what is the amount of that business. Whether that is exceeding 1 million dirhams in the year, if it is exceeding, then again it becomes subject to tax. And you're expected to register for corporate tax and then file the return. Not only a natural person, but also sole establishments, as I mentioned. Sole establishments are generally considered as part of natural person, means there is no difference between a natural person and sole establishment owner, a sole establishment. Both of them together are considered as one and same. So in which case, if individually with a sole establishment or an individual plus the individual sole establishment business income together exceeds 1 million dirhams, then you are expected to register for corporate tax and then file the returns. So this is the category of residents, of tax resident persons, which are expected to register their businesses or individuals and then comply with the requirement of the law. On the other hand, you have non-residents who are having their permanent establishments in UAE. So these permanent establishments also could be through your branch or other mode of presence, or it could be an individual who is representing that foreign company or an agent. So all those do establish your connection in UAE for your foreign company, and then it becomes a permanent establishment. Once you have permanent establishment in UAE, you are expected to register for corporate tax, though you are a foreign company, and then consider all that income that you generate through this permanent establishment in UAE, and then file the return for that particular income. That is what is expected. Second, then you have you are a non-resident person, but you have a nexus. You being a non-resident company, but you have a property in UAE in which you invested, you become owner of that. That creates an excess in UAE for your business in outside. Whatever income you generate in UAE through that nexus is going to be subject to tax, and then you are expected to comply with other requirements. Then third category is deriving UAE sourced income. Means a non-resident company is doing business with a resident company in UAE or a individual. So in that case, that business is considered as having UAE sourced income. That also becomes subject to tax in UAE, but that business which is outside UAE is not expected to register here, but they are indirectly subject to tax like withholding tax. So the UAE businesses which are getting the business from outside UAE are expected to deduct some withholding tax and then comply with this withholding tax requirements. But at the moment, the withholding tax is 0%. In effect, there is no withholding tax that is applicable now. That's what it is at the moment. But in future, if the FTA comes up with a different rate, maybe 5%, 2%, or whatever percentage, in that case, if UAE companies are getting any business or doing any business with outside UAE entities, they are doing business rather, then before they make the payment to that outside UAE entities, they need to deduct this withholding tax amount and then pay the net amount to that supplier. And then this 2% or whatever percent you deduct as withholding tax should be paid to the government. This is what is expected. But at the moment, as I mentioned, it is 0%, which means there is no, effectively, there is no withholding tax. So these are the categories of businesses that do fall under taxable person category. and then accordingly they are expected to comply with the requirements of the law. This I don't want to spend too much time on this. Any businesses which have which become taxable persons, depending upon their financial year, their first tax period will be defined. Based on that, within 9 months from the end of the first tax period, you are expected to submit your first tax corporate tax returns. About 95% of the companies, they have their financial year as January to December, for which the first taxable period is going to be 1st January 24 to 31st December 2024. So for that particular period, you are expected to submit your corporate tax return before 30th September 2025, which means within next 40-45 days, almost like 95% of the companies are expected to submit the corporate tax returns, first filing to be done. So it is advised that you complete your filing as soon as possible, because if you wait till the end, you may have some information that you may have to work towards, or you may have to spend some time to dig out and then submit. By then you may be late. Or if you are submitting on last day or last week, maybe you'll have some system issues because so many people will be accessing it. The FTA system may have issues. So you may have something or other, some issues which may delay your process, and then you end up in delaying or crossing the deadline. So it is always advisable that since it is almost like 7 months over, you must be having a fair idea of all your books of accounts finalized and everything is ready, then you can go for filing. Good. So you can see the tax rates that are applicable. You have two categories of tax rates. One is general tax rates, which are applicable for most of the businesses. Other one is rates that are applicable for free zone entities which become qualifying free zone persons. For them, the rates are different. General rates are like 0% tax on the taxable profits up to 375,000 dirhams and 9% in excess of 375,000 dirhams. So when I say taxable income here, it is the profit after making certain adjustments based on the corporate tax laws rules that becomes or that derives you to taxable income, and that is something that you have to look at whether it is more than 375,000 dirhams or less. If it is less than 375,000 dirhams, your tax rate is going to be 0% on that amount and tax payable amount becomes 0. If it is more than 375,000 dirhams on that excess amount, you have to compute 9% as tax, and then that becomes payable to government. On right hand side, you have qualifying free zone persons, means any free zone person, which we will look at it a little more detail in the later slides. But any free zone which becomes a qualifying free zone person after meeting certain conditions, for you, the tax rates are going to be two different rates. 0% on all your qualifying income, irrespective of the amount. It is going to be 0%, no tax to be paid. But if you have any income which is a non-qualifying income, on that, the tax rate is going to be straight 9% without any other limit or base. Even if you have 10 dirhams, on that 9% is going to be your tax amount if that income is a non-qualifying income. So on some other day, we'll definitely focus more on what is qualifying income, what is non-qualifying income, what are the conditions to become a qualifying prison person and all those things. But at the moment, in later slides, we'll touch base on this and quickly, just to give a basic understanding of it, and then we can discuss in detail in the later sessions. So these are the rates that are applicable. Any free zone person which is not a qualifying free zone person, for them, whatever is mentioned as general rates become applicable. So then 0% up to 375,000 dirhams and 9% in excess on that is going to be applicable for your company. So now from here onwards, I would invite Girish to take us through. He is going to take us through the corporate tax returns, some of the important areas by taking the extracts from the return form itself and trying to understand. You can drop in your questions in the chat box. We will also try to have some question and answer at the end of the session so that your question can be answered. Even if you have questions which are not answered, you can drop them in the chat box. We will try to get back to you directly by calling you or by sending an email to you. So let us just make sure that whatever question we have will be addressed or will be addressed either now or later on. So with this, I will hand it over to Girish. Girish, over to you.
Thank you very much, sir. Good afternoon, everyone. I hope everyone are done with their lunch. I know it is Thursday afternoon. Corporate tax may be a little boring for many of you, but here's the thing, like Balram sir just mentioned, that many return filings are due in September, which is just 40 to 45 days away. The deadlines are real, so we will have to, gather some attention and understand the return filing process so that we do not make any mistakes in the filing of the return, or we are not late in filing the return. So let us start off with the tax return filing and know how to fill in the return. So basically, the corporate tax return is a document which you are going to give it to the federal tax authorities, wherein you are going to report, listing down all your incomes, all the expenses, giving all those details, and telling that this is the income that you have derived and this is the tax that you are going to pay. It becomes a very important document because this is the only report that you're going to give to FTA, and FTA is going to rely on this and scrutinize this. So it is very important to ensure that all the details that are filled in over here are correct. Now, when you log into your portal and go to your corporate tax return filing, the first thing that you would see on the first page of the tax return would give you your pre-filled details that you would have given at the time of obtaining the registration. Things like the name of the company or the taxpayer, the TRN number, what is the entity type, what is the tax period, and also the contact details that you would have provided at the time of registration. It is important to verify all these details, because if any of this is incorrect, then a separate amendment application has to be filed, because these are some details that you cannot update in your tax return. So an amendment application has to be filed in advance to correct these details to ensure that they are up to date. Also, entity type and tax period will have a significant impact on your taxability, the scope of taxation, and various election options that we are going to discuss in the tax return in the next slides. So it is very important for you to ensure that all these details are correct. After verifying all this, the tax return requires you to give some basic details about your company, such as whether the company it is a partner in an unincorporated partnership. Unincorporated partnership is a partnership which is not registered. So this is disregarded by the authorities and it is not considered as a separate establishment, and therefore the tax is to be paid by the partners on the profits that the partnership is earning. So you will have to give that disclosure. The next thing is, there are certain people who are exempt from tax return filing and they are required to give only annual declaration. Some of these people are government entities, government control entities, entities who are into extractive business. So if you are any of those entities, you need to select yes over here, and then the return is just over. You just need to give an annual declaration. The next very important thing over here is the return asks you to disclose what is your revenue that you have derived during your tax period. The revenue over here includes your aggregate gross income without any deductions or without reducing any expenses. So this is your top line item, that is the revenue from your operations, as well as any other income. So for example, if the company is earning any kind of interest income or any income through ancillary activities which are not its main operations, all kinds of incomes, any gross income, any income or any receipt that you have got, you have to club all of that and report over here, and not just revenue from your operations. This is a very important point to be noted over here, because there are certain election options that depend on your revenue, the quantum of your revenue. The next thing is, you need to disclose whether the financials have been prepared. You're maintaining your financials on cash basis or accrual basis. In majority of the cases, IFRS based financials are prepared, which are mostly on accrual basis. However, corporate tax allows you to maintain financials on cash basis, provided your revenue does not exceed 3 million dirhams. The next thing is the business activities that you're carrying out in UAE and the number of business activities. Again, this is pre-populated basis the details that you would have provided at the time of obtaining the tax registration. If anything is incorrect and anything requires a change, then an amendment application needs to be filed. The return also requires you to give a breakup of your revenue. So whatever revenue you have reported, you need to give a breakup of that into various activities that you would have provided at the time of obtaining the registration. Again, this is a list of activities for which you would have obtained the registration. It is pre-populated. If any change is required, you need to go and file an amendment application. Here, you can give the percentage of the revenue attributable to each of the activities. If there are five activities, you need to give the bifurcation of your revenue into all those five activities. The total of this should come to 100 percentage. Now, whether the taxable person is a member of an M&E group. So, multinational group is defined to be any group where there are two or more entities in more than one jurisdiction, and the consolidated group revenue is more than 3.15 billion dirhams. So, if you are a company having various holding and subsidiary companies also in UAE and your revenue exceeds 3.15 billion, then you would not be an M&E group because you would not have presence outside UAE. So, it is important to have presence in more than one jurisdictions to be considered as an M&E group. If you have presence in multiple jurisdictions, but again, your revenue does not exceed 3.15 billion dirhams, then you are not an M&E group. So basically, you will have to analyze at the group level if you fulfill these conditions, whether that will be considered, whether you would be considered as a part of M&E group or not. Now, is a taxable person incorporated in UAE or not is also something which is pre-populated basis the registration type that you would have obtained. Also, if you are being considered as a non-resident in UAE or a tax resident of a foreign jurisdiction under applicable double tax avoidance agreements, in that case, you would have to select the appropriate selection. This can be the case where, for example, you have a company incorporated in UAE, but the main management or the people who are making the decisions are sitting outside UAE. In that case, the place of effective management would be held to be outside UAE, and you may be considered as a tax resident in that country, in that jurisdiction, basis the double taxation agreement between UAE and the other country. So you would have to analyze this if you have presence or if your decision making people are sitting outside UAE. So these were some of the basic details that are required. The return also requires some questions about the free zone, whether you are located in free zone, whether you are opting for the free zone benefit or not, which together we have covered in the subsequent slides. After completing the first part of your return, the next is the elections. There are various election options which are provided by the corporate tax law. And interestingly, many of these have to be decided in the first tax return itself, and they are generally irrevocable except under exceptional circumstances. So this makes your first tax return very important because the elections that you make in the first tax return would impact your taxation in the future years as well. The first election that we will be talking over here is realization basis. Now, like we discussed, the financials that most of the taxpayers prepare, they are on accrual basis of accounting. That means if you have accrued any kind of expense or any kind of income, you generally record that in your statement of profit and loss, irrespective of whether you have actually realized it or you are going to realize it in future. However, for corporate tax purpose, the law tells that you can recognize the gains and losses on realization basis when you actually realize it. For example, you would have created a provision for doubtful debts. That is a provision and you have not actually realized that loss or you have not actually incurred that loss, but you are just providing for it by preempting that loss. So in your statement of profit and loss, you would have debited it and you would have claimed it as an expense. However, if you choose realization basis, the deduction may not be allowed and it will be allowed only when you have actually written off that debt as a bad debt. Only then it would be considered as a realized loss. Similarly, you are holding any asset, there is any fair valuation gain. Again, this is a gain which is unrealized because it is only a fair valuation that your accounting standards require you to do, and fair valuation gain you are going to recognize as a credit in your profit and loss. But since this is an unrealized gain, if you opt for realization basis for corporate tax purpose, you are not required to include that income for the purpose of your tax or pay any tax on that income. So basically, the idea was that if any taxpayers they are earning huge amounts of income or revenue, but they are all unrealized in nature, then the taxpayers should not face any crunch in the payment of tax liability in those cases, because they would have not actually received that income. So it would be difficult for them to pay the tax on the accrued income. Now, under realization basis, there are two options that have been provided. This realization basis is available to any person who is not a bank or insurance provider. And the two options that are available is realization basis can be opted for all assets and liabilities that are subject to fair value or impairment accounting. Or the second option is it is available for assets and liabilities which are held on capital account. Only the capital account assets and liabilities you can choose to recognize on realization basis, and any gains losses relating to revenue account assets and liabilities you can continue recognizing the gains or losses on accrual basis. That is, what treatment is there in your financials will be followed for the purpose of your corporate tax as well. Now, examples of capital account assets and liabilities these would broadly cover all your non-current assets and non-current liabilities. So if you opt for the second option, that is realization basis only for assets liabilities held on capital account, then only gains or losses pertaining to your non-current assets liabilities will be taken on realization basis, and any current account assets and liabilities, any gains or losses pertaining to that will be recognized on accrual basis itself. This is an election which is to be made in your first tax return. This will be pre-populated, auto-selected basis whatever you choose in the first return in your subsequent returns. It is something which is not irrevocable. It is an irrevocable option, except in exceptional circumstances where you are able to prove to FTA. FTA is going to determine and allow on a case-to-case basis. The next election over here is transition rules. The law has been implemented in UAE from 1st June 2023, and it is applicable on the tax periods, that is the first financial year starting after 1st June 2023. The law basically allows you to exclude certain gains on sale of certain assets from taxation. Now, over here, what are the assets, liabilities that are covered? Any qualifying immovable property or any intangible asset you are holding, financial assets, financial liabilities. So basically, these are your assets, liabilities which are covered. If they fulfill certain conditions, the conditions would be you should be holding or having these assets before your first tax period. You should have been carrying these amounts at historical cost basis in your books of accounts, and you should be holding it for the purpose of disposal and not for the purpose of use in your normal business. So if you fulfill these conditions, then in that case you can exclude certain gains from taxation. Now let us understand this with an example. For example, you had acquired a land in 2015 for 10 million, and you have been holding that till the commencement of the tax. That is, as on 1st Jan 2024, you have been holding it, and the value of that land has appreciated to 15 million dirhams. Now, if you are going to sell it in 2026, for example, for 18 million dirhams, then ideally the income, the gain that you have earned in your P&L in 2026 would be 8 million dirhams. That is, the 10 million would be your cost and 18 million would be your sale value. So 8 million would be considered as your profit. However, it would not be right to tax the gain that you have accrued or that you have earned before the tax law was implemented in UAE. So, for that purpose, the law tells that you determine the value as on the first day of your first tax period. So, as when the tax was applicable on you, the value of the property had already appreciated to 15 million. Therefore, the 5 million appreciation that has happened before the tax came into effect in UAE, we are not going to tax that. So you can claim an exclusion of income of 5 million dirhams, and you are required to pay only tax on 3 million dirhams. That is a balance, the balance appreciation that you would have earned after the tax law has been implemented, that is after 2024. So basically, this benefit has been provided wherein you can exclude any gains that you have earned before the implementation of the corporate tax law. Basically, that is the idea. Now, this exclusion or this benefit would be available in the year when you actually sell those assets or settle those liabilities. However, whether you are going to claim this transitional rule benefit or not needs to be selected in your first return itself. So this exclusion of 5 million in our example, we are going to claim the exclusion of 5 million in 2026. However, in 2024 itself, you need to you need to give the details of the land and tell that this is the land which is a qualifying immovable property and I want to claim transition rule for this. I am going to claim the exclusion in the year when I am going to sell it. You need to give that disclosure in the first return itself. And again, this is a option which is irrevocable except under exceptional circumstances. Now, when you have selected that you want to claim this transition rule benefit, you are required to give certain details for your qualifying immovable properties in the first return itself, such as the address, the Makani number of that immovable property, date when you had actually acquired it, what was the cost, and if you were carrying it at net book value, what is the net book value as on the first day of the first tax period. You need to give these details, and when you are actually selling it, at that time you are required to disclose what was the value as on the first day of that first tax period and what is the amount that you want to exclude. So this is the basic idea of the transition rules, and appropriate disclosures need to be given over here if you want to exclude any appreciation or any gain which pertain to when the tax was not implemented in UAE. So this is a very important benefit which is provided by FTA, and proper disclosures and proper elections are to be chosen in the return to avoid any challenges from the authorities. After the two elections, if your revenue is within 3 million dirhams, then you are eligible to opt for small business relief. What is this relief? Basically, the authorities have told that if your revenue does not exceed 3 million dirhams, in that case, you can come and claim before the authorities that I do not have any taxable income, and you are required to file a simplified return. If you opt for small business relief, your tax return ends over here. There's no further requirement of disclosure, no further details to be given, or no attachments also to be provided. So if your revenue is within 3 million, again, revenue over here is the gross income, the total revenue. It includes the revenue from your operations as well as any other income that you are deriving. So this quantum declaration becomes very important, because basis this you are going to find out whether the taxpayer is eligible for small business relief or not. Now, this is available only to resident persons. It is not available to non-resident persons. Only resident persons can avail this benefit, and provided their revenue does not exceed 3 million dirhams, you can file a simplified return, just give a disclosure of your revenue, and the return is done. Now, exceptions to this is if you are a member of an M&E group, then FTA does not want to provide this relief. It wants you to file a detailed return providing all the necessary disclosures that we are going to discuss. Or if you are willing to claim the qualifying free zone person benefit, if the company is located in a free zone and you fulfill the conditions for 0% tax rate in UAE and you want to claim that, in that case, you need to give a detailed return. A simplified return would not do. Now, this is just a momentary relief, a transitional relief that the FTA has provided to small businesses until they get accustomed to the tax laws and they understand the compliance requirements. So this benefit of filing a simplified return is available only up to financial year ending before 31st December 2026. So basically, taxpayers following a calendar year, Jan to December, they are eligible to claim the small business relief. until 31st December 2026, that is for a period of 3 years, 2024, 2025, 2026. Provided you have met these conditions, your revenue does not exceed 3 million dirhams, you're not a part of M&E group, and you're a resident person. Now, one of the important drawback of this thing that taxpayers need to be aware of is that the moment your return ends over here, you have not given any disclosure of your taxable income. Whatever is the quantum of your net profit, we are not going to tax it. But on the other side, if you have incurred any losses, we will not allow you to carry forward those losses. So this is what happens if you finish your tax return over here by claiming small business relief. You would not be eligible to carry forward the losses. So it becomes very important to determine whether this relief is available, whether it is beneficial, and do your tax planning properly in the first year itself. After this, there are certain other elections which are there. The first, the first thing over here is qualifying group relief. The next is business restructuring relief. So there are certain detailed conditions that are provided over here, which if the taxpayer fulfills and there has been any transfer of asset liabilities between them, between the group companies, the qualifying group companies, in that case, the transfer will be considered to have happened at book value. There would be no income recognized or any loss recognized on the transfer of such asset or liability. It would be considered as a tax neutral transfer. Also, if the company is having any presence outside UAE, which happens to be its permanent establishment, then you can make an election to claim foreign permanent establishment exemption. In this case, you can exclude the results of your foreign operations completely, and you are required to only pay tax on your UAE operations by claiming this exemption. So basically, these were some of the elections. The realization basis, whether that is beneficial to you or not, it should be analyzed properly. The transition rule relief, whether you are eligible to claim any of your asset qualifies for that relief or not, to exclude the gains which you have accrued before the tax was actually in effect in UAE. Then whether small business relief is applicable and available to you, and whether it is actually beneficial for you, qualifying group relief, business restructuring relief, and foreign PE exemption. So these were some of the important elections that are required to be selected. The first two that we spoke are to be done only in the first tax return, as already mentioned, and they are irrevocable in any future tax returns. So it becomes very important to analyze in the first tax period itself whatever options you want to choose, because that would have impact on your tax liability in future years as well. Now coming to your next part of the tax return. This is a pretty simple portion where you are only required to give the details of your financial statements. One thing needs to be kept in mind. This is basically, you need to replicate your financials over here. You need to give the details of your operating revenue, the direct costs that you have incurred in deriving your operating revenue, all the non-operating expenses. To the extent that FTA is requiring you to give item wise disclosure, please find out those items and give the item wise disclosure, and all other expenses can be clubbed and given over there. One important point that I would want to highlight is it requires you to give a separate disclosure of client entertainment expenses. As per the UAE corporate tax law, entertainment expenses are allowed as a deduction if you have incurred them for employees. However, if you have incurred any kind of entertainment expense for any person other than your employees, whether they are your business partners, they are your suppliers, potential suppliers, your customers, for anyone, subject to certain exclusions. If you are offering them meals in the office setting, then that would not be considered as entertainment expense, etc. Subject to those exclusions, any entertainment expense incurred for any person other than employee will be allowed as a deduction up to a maximum of 50 percentage only. That is, beyond that, it would be a disallowance of 50 percentage of your entertainment expense. And entertainment expense includes your travel related costs. For example, you are incurring your travel expense for your clients for any trip outside, or you are providing them any free accommodation or providing them free meals. So these are some of the examples of entertainment expense. You will have to identify them and then clearly report over here, because this will have an impact on your disallowance that we are going to see in the subsequent slides. So this basically, you need to give the details of your profit and loss. To the extent possible, the bifurcation needs to be given. Your non-operating revenue would come over here. Any kind of other income, dividend income, interest income, or any other thing that you have earned, you need to give it over here. Interest expense, your finance cost also requires to be reported separately. And you have derived any gain or loss from disposal of assets also needs to be mentioned over here. Forex gains and losses are also required to be mentioned separately. If they are clubbed anywhere else, please find out and give separate disclosures over here. After this, there is a requirement to disclose your other comprehensive income if you have derived anything. Basically, over here, a few taxpayers, they have to recognize gains or losses under the other comprehensive income schedule, as per IFRS. Now, an important question that arises over here is, what accounting income is to be used as your starting point for determining your taxable income? The law tells that your taxable income, we are going to take your net profit from your books of accounts, we are going to make certain adjustments, certain plus and minus, and then after that plus and minus, whatever amount comes, that is your taxable income on which you are required to pay taxes. So what is the net profit that they are going to consider? What is the accounting income that they are going to consider as a starting point? It is it is an amount of, as per statement of profit and loss, that is before other comprehensive income. So what happens to the expenses or incomes that you are recording in your statement of other comprehensive income? Now, other comprehensive income is basically of two types. One can be reclassifiable and non-reclassifiable. The law tells that reclassifiable would anyways go and hit your profit and loss when you have actually sold that asset or when they have been actually realized. The non-reclassifiable nature of items will have to be adjusted in your tax return in the year when you are recording itself. After this, you are also required to give the details of your balance sheet, that is the statement of financial position. You have to give the details of your current assets, current liabilities, non-current assets, non-current liabilities, and the details of your equity. Just like you have your financials, all the details need to be punched in over here. Now, an important thing over here is that FTA requires you to give a disclosure of employees that are there during the tax period. Now, who are what is the disclosure that you need to give over here? So you need to give a details of average number of employees during the year. That is, you need to take the number of employees on the first day of the tax period and on the last day of the tax period, and you need to average it out and give it over here to the approximation of one decimal. So FTA has also provided that decimal. So to the extent of one decimal, the detail need to be provided. The average number of employees needs to be provided, and you need to consider only the employees who are an employment contract of that taxpayer of or of that company. uh, it is a very common practice in UAE, where you obtain the visa or obtain the visa of an employee under another company, and the employment contract is with another company. However, that employee works for your company. Such cases may not have to be included over here, and appropriate adjustments need to be made so that your financials also appropriately disclose your expenses for those employees. Now, FTA also requires you to mention, if you have got your audited financials, then you need to give the details of your auditor, the name of the auditor, and you are also required to mention what is the nature of the audit opinion. This becomes very important for the FTA, to filter the tax returns, or where they have to focus, or to find out cases where they may have to dig in and verify the tax returns. So what is the nature of the opinion also needs to be reported over here, whether it is a qualified opinion or it is an unqualified. And unqualified, it is disclaimer, adverse, or whatever. After filling the details of your financials, your profit and loss, other comprehensive income, and your balance sheet, and the average number of employees, then Now you have given the details of your financials, you have given the details of what is your accounting income. From here, like I mentioned, taxable income is your accounting income plus minus the adjustments that are provided. So, what are those pluses and minuses that you have to do to your accounting income to finally derive your taxable income? So, over here, accounting income is something that you need to give over here. Like I mentioned, it is your net profit as per your profit and loss statement and not after your other comprehensive income. That would come over here. Then, if you are following equity method of accounting, that means you are recognizing your portion of gains or losses in any investment in associate or joint venture. You need to select yes and exclude that gain or loss that you have recognized. Any income, any gains or losses that you have recognized in financials but will not be reclassified in your income statement needs to be reported over here. This would include cases where you have other comprehensive income which are non-reclassifiable, like we discussed, or anything that you are doing a balance sheet adjustment which will never hit your statement of profit and loss. So even those do not escape taxation, you have to disclose over here. Now, if you have earned any kind of exempt income, say if you have earned any dividend income from another company in UAE, then that is exempt. You need to give details of that. Also, if you have earned any dividend income from companies which are outside UAE, or you have earned any kind of capital gains on sale of shares of any company, then if participating exemption benefit is available, you need to give the details of that. So participating exemption is something, a benefit which is provided by the law, wherein if you have fulfilled certain conditions, the shareholding conditions, the period of holding conditions, in that case, all your income is going to be considered as exempt pertaining to that participation that you are holding. That is the investment that you are holding. Any income from that would be considered as exempt. For example, your dividend income or your capital gains income that you are earning, provided those conditions are fulfilled. So another thing over here is to detailedly analyze if you're fulfilling those conditions and claim that exemption in your tax return properly. After this, if you had mentioned that you are going to elect the transition rule benefit, you want to exclude the gains in relation to your qualifying assets or qualifying liabilities, then you can exclude the gain. In our example, if you remember, it was a 5 million gain that we had to exclude. So in 2026 return, when you're going to file, you have to select the relevant options over here. You need to select yes, I want to claim that exemption, fill in the schedule, which will take you back to the same schedule that we just discussed, and give proper details and give the details of the amount that you want to exclude from taxation. Then after this, there are certain other adjustments that you are required to make in your tax return. Like we discussed, the entertainment expense. What is the non-deductible entertainment expense? Any entertainment expense that you would have incurred for other than employees, you need to disallow it. That is allowed only to the extent of 50 percentage maximum. Now, what is the disallowance that you need to give over here? Suppose you had reported 100,000 in client entertainment expense in your accounting schedule, and you report only 40,000 over here. Then you are going to get an error, because this amount is something that cannot be less than 50 percentage. That is, at least 50 percentage of your client entertainment expense needs to be disallowed, and there's a linkage over here. So it becomes very important, even when you're filling your accounting schedule, that you fill all the details properly, because FTA is going to have internal linkages to find any discrepancy in your subsequent reporting in your tax returns. Also, if there is any pension contribution, if there is a private pension contribution, you need to be aware of the disallowances. If the contribution is more than 15% of remuneration, or you do not actually pay it, you need to identify those cases and disallow. If you have incurred any kind, if you have made any donations or any zakat payments in UAE, or to any person who is not a qualifying public benefit entity, you need to disallow it 100%. So even donations or zakat payments would not be allowed as a deduction. Any income that you are, any expense that you have incurred in deriving exempt income needs to be identified and disallowed. If any dividends has been debited to P&L, any dividend payout has been debited to your profit and loss, it needs to be disallowed, because it's an appropriation of profits. Then any expenses which are personal in nature, incurred for owner, incurred for sole proprietor, which are not wholly exclusively for the purpose of business, they need to be disallowed. And other non-deductible expenses. So these would basically include any kind of gifts, any kind of penalties, or any kind of fines that you would have paid for violation of any law or anything. All of those need to be clubbed over here and it needs to be disallowed. So there are various other provisions of disallowances as well. They need to be analyzed properly. Your profit and loss needs to be scanned properly. Your trial balance needs to be properly analyzed, and even any expenses which are not allowed as a deduction, which may not be covered in the above list, you need to consolidate this and give the disclosure, give the combined amount of disallowance over here. Next comes is your disallowance for your interest expenditure. So, many of us would have heard that there are certain thin capitalization rules as the OECD guidelines lay down. Basically, it tells that interest expenditure cannot be exceeding certain amount, or your debt cannot be exceeding a certain amount of your equity. So in UAE, basically the law tells that if you are incurring any expense which is more than 12 million dirhams, then we are going to analyze and subject it to certain disallowances, because otherwise this would lead to shifting of profits. In place of dividends, people will take out profits from the jurisdictions by way of payout of interests. So over here, the law tells that if you are incurring any interest expense which is above 12 million dirhams, then we are going to analyze your EBITDA, and 30 percentage of your EBITDA or 12 million, whichever is higher, only to that extent the deduction would be allowed. Anything excess will have to be disallowed. You can carry it forward and claim it in your subsequent tax returns. However, this can be carried forward only for the period of 10 years. And another important thing to be mindful of over here is your net interest expense is tested for 12 million threshold. That is your interest expense minus any interest income if you have derived. Now coming to what all other adjustments that would be required in your tax return. If your interest expense is within 12 million dirhams, then yes, this disallowance rule would not apply. It applies only if your interest expense, net interest expense, exceeds 12 million dirhams. Now, this is a very important point which would require proper attention. So, if the company is having any related party transactions, that is, you are entering into any intercompany transactions, any transactions with your group companies. Broadly, it would be any intercompany transactions. Then in that case, it needs to be ensured that your related party transactions are on an arm's length basis. Now, what do you mean by arm's length basis? Arm's length basis basically means the terms of your transaction between intercompany should be as per the terms that you would have agreed with a third party. That is, it should be on an independent basis, and it should not have any kind of uh, it should be completely independent, and it should not be influenced just because your group companies wherein you are not entering into terms that are not as per the market standards. So basically you need to ensure that the transactions, the terms of the intercompany transactions, are on an arm's length basis. The transactions could be sale or purchase of goods, transfer of assets or liabilities, giving of advancing of loans, and various other things. All those cases, you need to benchmark those transactions to ensure that they are on an arm's length basis. You need to justify it before the authorities that they have been entered on an arm's length basis, that is as per the market standards. And there has been no impact of us being related parties among ourselves. An important point to note over here is that although a head office and its branch are considered to be a same entity, however, if you are having a head office or a branch outside UAE, in those cases, those will be considered as your related parties. They would be considered as separate entities, and any kind of cost allocations or revenue allocations between the head office and the branch, although considered as a part of same entity, will have to be benchmarked to an arm's length basis. Now, the disclosures that your return requires over here is, were there any transactions in relate with related parties? If you mention yes, there would be a next question asking you to tell what has been the aggregate value of the related party transactions. If the value of related party transactions was less than 40 million, then you are not required to give detailed party wise disclosure of your related party transactions. You just need to mention that yes, we have entered into related party transactions during the year. However, no transaction, the aggregate value of transactions did not exceed 40 million. Now, in that case, if FTA wants to subsequently ask you any further details, they are going to come and ask. But in the return upfront, you're not required to give any kind of disclosure. However, please keep all your necessary documentation ready in case the FTA wants to check. Now, if the aggregate value of your transactions exceed 40 million, and your per category value of related party transactions exceed 4 million, only those transactions you need to give the disclosures. If the aggregate value of your transactions exceed 40 million, but for a particular category of transactions, say my dealing in goods, the value of dealing in goods did not exceed 4 million, so any related party transactions under those category may not have to be reported over here. So only aggregate value of transactions should exceed 40 million, and only the categories where the aggregate value of per category basis exceeds 4 million, those transactions are required to be reported. You need to give details such as the name of your related party, the what is the transaction type, what is the price at which you have entered into transaction, what is the arm's length value that you have determined basis your analysis, and what is the method that you had used to determine that. Similarly, there is a connected person schedule. Basically, UAE has a concept wherein it tells that any amount which is withdrawn by a natural person from his company, a natural person who may be the owner, officer, director, any person who is capable of influencing the decisions of the company, any amount that he draws, that also needs to be justified that they are at market standards, and a disclosure also needs to be given if the transaction per connected person basis exceeds 500,000 dirhams. So basically, if it exceeds 500,000, you need to give the details for those connected persons. What is the payment of benefit that he has derived, and what is the service in return that he has provided to the company for taking that payment of benefit from the company. Now, over here again, the name, description of the services are required to be given. What is the value of payment benefit, and what is the market value as per your analysis? Over here again, it becomes important for you to have proper analysis in place, get a proper benchmarking or a justification report done, so that in case the authorities ask in future, you are able to substantiate that the payment that the owners or the directors or the managers they have derived, they are justified, they are at market rates, and they are not excessive. So you need to have proper documentation in place to avoid many FTA queries on these things. Now, if you do not find them to be as per market standards, you can disallow the excess portion that, as per your analysis, I have found out that these are the market standards. However, the transaction or the payment benefit that I have paid out is this much, and this has been the excessive amount, and I am ready to disallow that, because the deduction is only allowed to the extent of the reasonable amount of payment or benefit that you give to connected persons. Now, one important thing to highlight over here is that the transfer pricing documentation, although there is no such disclosure or requirement to report or attach anything over here in the return, however, it is important to know that you are required to maintain the master file and local file if any of these two conditions are fulfilled. That is, on a standalone basis your revenue exceeds 200 million dirhams, or on a consolidated group level basis the revenue exceeds 3.15 billion dirhams or more. Any of these one conditions, if they are fulfilled, you are required to maintain adequate transfer pricing documentation, master file and local file. Again, the thresholds of 200 million, 3.15 billion, 500,000, 40 million, or 4 million, the disclosure requirements that we saw, all these are the thresholds for TP documentation or for giving the disclosures in the tax return. There is no threshold for ensuring that your related party transactions or connected person transactions are on an arm's length basis. Even 100 dirhams transaction, 100,000 dirhams transaction, or 10 million dirhams transaction, everything will have to be justified. It needs to be at market standards. Only thresholds are provided only where you have to give detailed disclosures or where you do not have to give disclosures, but there are no thresholds to for you to escape the justification or to ensure that your transactions are reasonable and on an arm's length basis. Now, after all these adjustments, for accounting income, we gave the details of our financials, then we gave the details of all the adjustments, the disallowable expenses, the exempt incomes, the transitional benefit that we are taking. After all these plus and minuses, after related party adjustments, after all these adjustments, you are going to get your taxable income. Now compare this with your computation. If this amount is correct, your tax liability computation would be correct. And then in your tax, if at all you want to claim any tax losses, in that case, you will have to fill a schedule, or if you have incurred any tax losses and you want to carry it forward to future years, you need to fill a tax loss schedule. UAE laws allow you to carry forward your tax losses for indefinite period. So it becomes very important to analyze if you have incurred tax losses and you expect them to be set off against future profits, to for you to give proper disclosures, make proper elections, and show the tax loss in the tax return and then carry it forward to future years. The law also allows you to transfer your tax losses amongst your qualifying group people, wherein you can take tax losses from another qualifying group entity or you can transfer it to your another entity as well. So there are certain conditions to be fulfilled and proper disclosures that are required to be given in the tax return. After this, your taxable income is computed, your tax liability is computed. If you have operations in a foreign country, you have the option to claim foreign P exemption, like we just mentioned. Or if you have paid any taxes in foreign jurisdiction, you can claim a tax credit of those of that tax that you have paid outside by giving filling proper schedules and giving proper disclosures, which would basically include the country of residence, where you have paid the tax, what is the nature of income, quantum of income, what is the amount of tax that you have paid, what is the nature of the taxes that you have paid. So things like this will have to be disclosed in the tax credit schedule. So basically, like we have seen, the tax return, although a few places they are just yes and no selections, some disclosures are required, they are subject to certain thresholds, etc. But it is very important to know that each election option or each yes and no that you are clicking may significantly impact your future tax returns. The tax return is basically requiring details of everything from start to end of your financials, the adjustments, the nature of expenses. They want you to disallow it, the related party transactions, everything. Disclosures are required to be given and they have to be correct. If FTA gets any doubt or if they find out anything in the scrutiny that anything was not properly given, then they are going to disallow all of that. They are going to levy penalties. So it becomes very important to select everything properly, to not lose out on any benefits or reliefs that are provided, to not lose out on any exemptions that are there, and to not incorrectly make any disclosure or reporting in your tax return. So it needs to be very comprehensively looked at. Now, coming to the attachments. Towards the end of your tax return, you are required to give certain attachments. Now, what are these attachments? Basically, you are required to give the details of your financial statements, documentation to support any market value if you have chosen for transition rule relief, or if you have chosen for transition rule relief, you can give the reports of the market value, how you have determined the value of the property to be this as on the first day of the tax period. If you are claiming foreign tax credit, then the details of the taxes that you have paid, tax residency certificate if you are claiming residency in UAE. So things like this are required to be given. Out of these, Your financial statements are a mandatory attachment. You cannot excuse me, you cannot proceed with the filing of the return without attaching your financials. It's a mandatory attachment. If you are not attaching, you need to give reasons why you would not be able to attach. The reasons are required. They should be legitimate and reasonable why you are not able to attach. And if you are claiming FTC, then you need to give the details of your taxes that you are paying in the foreign jurisdiction. That would also be mandatory. Everything else is optional. They are not optional to maintain. They are not optional, but they are optional to attach in your tax return. It is mandatory for you to maintain it with you because the FTA may come out later and ask you for the details. They are not required to be upfront given with the tax return, but they should be ready with you in case the FTA asks. Also, the law requires you to maintain the details or your tax records or the records supporting your tax return for a period of 7 years from the end of the tax period pertaining to which you are maintaining those records. So you cannot claim subsequently that the tax return pertained to XYZ years, it was 5 years ago or anything. The law has upfront come and told you that for a period of 7 years you need to retain it. That is, any time during this period, if the FTA asks you for any kind of records which help in justifying the details that you have given in your tax return, or that enables the FTA to ascertain your taxable income, to verify the taxable income, you need to maintain all such supporting documents, and that too for a period of 7 years. Now, let us just touch base upon the QFZP related disclosures, some special disclosures that would be required for a qualifying free zone person. If you want to claim this benefit, what are the disclosures that you are required to give? So basically, for all other people, it would be the normal detail written that we have discussed. And for qualifying free zone persons, there is an additional part in the tax return that needs to be filled in, and it appears if you are choosing for this 0% benefit. In your first part of your tax return, you are required to mention if you are located in a free zone. If you are opting out of the free zone regime, you want to go with the standard regime, and if you are fulfilling all the conditions for the 0% benefit. To briefly elaborate the conditions for 0% tax rate benefit, first thing is that you need to have adequate substance in your free zone. That means it should not be just a company floated in a free zone for claiming 0% benefit. You should have adequate employees over there. You should have adequate assets over there. You should be incurring expenses from that free zone presence that you are having in that free zone. It should not just be a company which is floated over there. So adequate substance needs to be maintained in the free zone. Second is you should be deriving qualifying income only. That means qualifying income includes any income that you are deriving from other free zone persons, or any income that you are deriving from qualifying activities. However, there should not be any income from excluded activities that would not be considered as a qualifying income. Now, the third condition would be that it has given you a buffer of 5% of your total income to be any other income. So you should be earning qualifying income only. However, 5% buffer is given wherein you can earn any incidental income which may not be considered as a qualifying income. It may not be from free zone, or it may not be from a qualifying activity. Say, for example, any interest income that you have derived by parking surplus funds in any investments or anything, that income should not exceed 5% of your total revenue. So a buffer of 5% has been provided, which is a de minimis requirement. Now, after this, the fourth condition is that you should not opt out of the tax free zone tax regime. You should not have opted for a standard tax rate regime. So you should not opt out of this regime, and then maintain audited financial statements and comply with all the transfer pricing related provisions. Now, over here, you need to give the details of your revenue again, the revenue from a foreign PE, because that would be excluded, and then your de minimis requirement would be computed. Say, for example, 1 million is your total revenue. Out of that, relating to foreign PE or domestic PE, it's 200,000. Then, for the purpose of de minimis, 800,000 would be your revenue. and your other income should not exceed 5% of this 800,000. Also, if you have any commercial property, then certain disclosures are required to be given for your commercial property which are there in the free zone. After this, you need to give the details of your non-qualifying revenue, revenue from excluded activities, from any activities which are not qualifying activities, or from not from another free zone person, that needs to be given. Then whether your these non-qualifying revenue is within 5% limit or not, that is auto computed by your tax return, and the de minimis condition is fulfilled or not is automatically selected over here as yes or no. We cannot change it manually. Then you need to give the bifurcation of your qualifying revenue. You need to fill in certain details to substantiate that you have adequate substance, such as what is the number of employees in the free zone, what is the operating expense, capital expense that you are incurring in the free zone, and if you have outsourced your activities, what are you need to give the details of the entity to whom you have outsourced. The return requires you to explicitly check box every condition subject to which you will be eligible for 0% benefit. FTA basically wants to ensure that you are aware of all the conditions and you are confirming that you have fulfilled all the conditions. You have not missed out on any of the condition. Having adequate substance, adequate number of employees, adequate operating expense, related party transactions are an arm's length basis, transfer pricing documentation maintained, and financial statements have been audited. Now, maintaining financial statements, uh, you need to attach the financial statements as a mandatory attachment. However, having audited financials is only required in two cases. One is if you are a qualifying free zone person wanting to claim 0% benefit, and the second is if your revenue exceeds 50 million dirhams. In that case, audit of the financials is mandatory. In all other cases, you can or may not get your financials audited. This is only the requirement from the corporate tax perspective. You will have to analyze the requirement from your local regulatory authorities or from the authorities wherever you are registered. Now, QFZP schedule also requires you to give emirate-wise details of your EBITDA and your salaries and wages, that any expense or EBITDA that you have incurred in these different emirates, you need to give the bifurcation. If you have presence only in Dubai, say in Javza, then you are required to give all your EBITDA and salaries and wages in your Dubai emirate, and all others would be nil. So basically, with this, we come to a conclusion of the tax return. It is a very comprehensive document, a detailed document requiring you to disclose, where every minute selection, every minute disclosure that you give has great impact on the taxability of not just current year but of future years as well. So please analyze, determine, have a proper tax planning, and then file your tax returns. So as we would have seen, there are many disclosures, many analysis that is required to be done, and you cannot start your return filing process just in the last week, and you may not be able to ensure that the return filing is completed within the deadline in that case, or you may miss out on certain disclosures or file any incorrect return or choose an option which would not be beneficial for your company. So please start off with the return preparation process well in advance so that everything is seamless. We have also listed down certain items, certain pre-filing checks for you to ensure that your compliance is seamless. So now over here to quickly give you a glance, if you have obtained late registration, it is 10,000 penalty. For late filing, it is 500 per month, up to 12 months, 1,000 per month from the 13th month onward. 14% per annum penalty is applied on a monthly basis if you do not pay your taxes on time. If you file an incorrect return, you can amend the return up to the due date of your return filing. There is no need of any voluntary disclosure. However, if the due date has passed, then you need to file a voluntary disclosure. 500 dirhams is the penalty for your incorrect return, and then the penalties for voluntary disclosure relating penalties will apply additionally, which would be substantially high. Now, just to give you some pre-filing checks, please obtain CT registration. We have seen in many cases where the clients have not even obtained the registration. So please have registration and please ensure that the registration details are correct and up to date, else apply for amendment applications and get them corrected. For financials, be prepared. Prepare your financials as per IFRS. Have AED based financials ready because your tax computation requires this. Have the bifurcation of taxable exempt income ready, employee non-employee related entertainment expenses ready, so that in the later stage you do not find it difficult to find the bifurcation and everything. Do not mix your business and personal expenses, and if possible, it is better to keep a proof of your expenses as well, such as lease agreements for your rent expense, your employment contract supporting your salary expense, etc. FTA may ask for these to verify the genuineness of the expenses that you're claiming. From transfer pricing perspective, identify properly who are your related parties, what are the transactions you have entered, who are your connected persons, as per the definitions that are provided in the law. Report them properly in your financials. Carry out benchmarking exercise well in advance. Maintain documentation wherever applicable, and also have intercompany agreements and invoices in place. Now, as we discussed, there are many reliefs, many benefits that are provided. To not miss out on any of them, please analyze before in hand. Please determine if they are advantageous to your company and whether you should be opting for it. Now, coming to what are the possible red flags. Now, given that this is a first tax return and we are definitely going to learn out of experiences in future. However, what are some of the possible red flags that FTA may analyze? This is something that we are preempting, and FTA may check or may reconcile these things, and they may analyze and ask you questions. So, what are the possible red flags over here? If there is any significant inconsistency in the data that you have reported in your tax return vis-a-vis the VAT returns that you have filed, if there are any inconsistencies, please have reconciliations in place, or if they do not match with your financials. If there are CT returns with huge revenue and very low profits, whereas as per your industry standards, people are earning high margins with high margins, then in those cases it may pick. CT returns claiming huge tax losses, FTA may want to analyze, they may want to check that the tax losses are correct, because only then they would allow you to carry it forward. Like we mentioned, if financials are audited, you need to give the nature of opinion. If there has been any qualification of the audit opinion, then FTA may want to check what is it that the auditor was not able to verify, and why is it that he has qualified the opinion. There are large related party transactions, there are significant connected person payouts, and you do not have proper arm's length pricing, that may lead to a detailed audit being initiated by the FTA. We are claiming QFZP status while dealing with the mainland entities to analyze whether you are actually carrying out qualifying activities. Now, you are also required to give details of employees. If those do not match with your revenue levels, then that may create some doubt with the FTA. This is possible maybe if you have not obtained registration on time, you have not done return filing on time, you have some record of past incorrect VAT filings. Please ensure that you file your corporate tax return properly, because we are not sure, FTA may have flagged such companies to check properly, so that such companies do not make any incorrect disclosures in the corporate tax return as well. Now, some of the very common myths, and quickly, what are the correct answers to them? Companies who are in the free zone. I am in a free zone and I am a tax-free company. I am not required to comply with any of the corporate tax laws. That is not correct. You are required to fulfill certain conditions as we discussed. You are required to obtain registration. You are required to file the tax return giving appropriate disclosures. If I have fulfilled the qualifying free zone person conditions in the first year, I will have the 0% benefit for the next 5 years. This is not true. You need to fulfill the conditions every year. However, if you do not fulfill the conditions in any year, you will be disqualified for 5 years. So the disqualification will impact your 5 years, but qualification, whether you qualify, you need to check on year basis. Now, I do not have income above 375,000. There's no tax liability. In that case, I'm not required to file tax return. That is incorrect. Filing would still be mandatory. If I'm a small business with 3 million dirhams revenue within that, in that case, I'm not required to file the tax return. Again, like we saw, it's a simplified return. However, you need to file the return and claim the available relief. Now, this is another important thing where we have seen a lot of confusion in the market and hard time explaining the clients. When your company is in liquidation, but it is not completely liquidated and your company's name has not been deregistered with the UAE authorities, it will be considered in existence until that event happens. You will have to obtain registrations, you will have to file the returns, the final tax return, and then deregister for corporate tax purpose. Otherwise, this would be a non-compliance, and then penalties may be levied against the company. Now, transfer pricing is applicable only if revenue exceeds 200 million dirhams. Like we discussed, there is no threshold for benchmarking. You need to ensure that your transactions are on an arm's length basis, irrespective of the quantum. Now, there is a concept under VAT law also, wherein you can form a VAT group and VAT would not be applicable amongst the transactions in that VAT group. Similarly, there's a concept, there's another concept under the corporate tax law, which is the tax group. Now, since both these words are same, the clients often have confusion that we are already a group as per VAT, so are we a group under the corporate tax as well? Both are different, both are having separate conditions, both are having their separate benefits, and they are under the different laws. They can be independently opted, and the the grouping under one law does not impact the grouping under the another law. So, with this, basically, we have come to the end of this session wherein we try to highlight what are the compliance requirements, how you need to fill the return, certain key areas where you need to be mindful of, what are the areas for which you need to be well prepared in advance, what are the areas where you need to be mindful where the FTA may be having a watch, and also, debunking certain myths or certain misconceptions. So, with this, we come towards the close of the session. If there are any questions,
Yeah,
anything
yeah.
that we can take it up.
Yeah, Girish, I think there are many questions. Some of them have already answered directly also in the chat
Okay.
box. So I'll just read out few of them, considering the time constraint we have. Should other income be also provided in the activity section, as the same activity may not be available in the trade license and hence in the taxable person details? So they may be having other than the main activity income. So where should that be reported in the filing? So
So,
if it is, I think, ancillary kind of activity related income, it will go under the same main activity. But if it is something different from that completely, so where should that be reported? Under the CT returns.
So basically, if you have other income, now over here you need to, because your other income would not fall any of the in any of the business activities. So you need to give the revenue breakup of your main revenue from operations only and give that. And in your accounting schedule, you will have to give the details in your other income. Now, in such cases, we have observed that you can proceed with the return filing even if your total of your percentages is not matching 100%. So, you can take a position that the balance revenue portion that was there, that was pertaining to other income, and you can proceed. However, detailed, more clarity on this is awaited.
Yeah. So a UAE national owning investment properties and generating rental income. There is another real estate company which is sole establishment, but is saying LLC of this national just to facilitate the tenancy renewal. So source of income is commission or admin and ijari fees only. As per our understanding, the rental income coming to personal bank account of national is out of scope of CT as investment income of natural person, and only the license activity of this LLC company is subject to corporate tax. So yeah, first the second thing about the income that is accounted under company definitely will be your taxable income. The question will be about the rental income that is accounted under the individual's account. So whether that becomes your business activity income or not is something that has to be looked at. I think here, since that individual only owns that company to operate your properties, which means you are running the business to manage your properties. Uh, this is a little dicey. When you see in substance, Sole establishments are generally considered as not different from or independent from the owner. In that perspective, you are having your own team of people running your or managing your properties. By considering that, the whole income may be subject to corporate tax as business activity. But if it is LLC company or independent of your individual person or individual or the owner, then in that case, it may be considered as independent and then only rental income is investment income and may not be subject to tax, but other income which is coming under LLC is subject to tax. This is what I think, but yeah. So as I mentioned, it is not a straightforward thing to look at. Girish, if you have anything else to say with respect to this point.
That's fine, sir.
Yeah, right. There's one more interesting question here for a tax resident under double taxation rules. What impact does it have if the management is Indian resident? This is for a free zone entity with a revenue below 3 million dirhams. So I think there are more than one
So
points to consider here. You're saying under double taxation rule, what impact does it have if the management is in India? Means the entity is effectively controlled and managed from India. For a free zone entity, the revenue is less than 3 million dirhams.
hmm. So here you may have to analyze your double taxation rule. There may be tiebreaker rules because you would be considered as resident in both the countries. So as per those tiebreaker rules, ultimately where are you considered resident? If ultimately it is decided that you're non-resident in UAE, then things like SBR and all they may not be available. So it becomes important for you to analyze from
Yeah.
double taxation
But prima
perspective.
facie, it looks like it, since it is a free zone entity in UAE, based on residence, you will have tax rate in UAE itself. In most of the cases, this is what it is. As you mentioned, if it is a resident person in UAE, tax subject to tax only in UAE, then you can go for this small business relief and then try to do that. But free zone entities, once you go for small business relief, then you will not be eligible for qualifying prison person for next 4 years, including this 5 years it becomes current year. So if it is not, that is when you have to look at whether you are eligible for SBR or not. In general, it is not if you are a non-resident or if you're not becoming a tax resident in UAE. Can tax period be more than 12 months? I think this question I've answered directly also. Generally not, it is generally for 12 months, but in exceptional cases where your company is incorporated after regime period, and in that case, you may have a first tax period which is less than 12 months or more than 12 months, but it cannot be lesser than 6 months and cannot be more than 18 months. That's the rule. It may also be similar in the case when you're going for liquidation of the company. Or if there are any changes in your accounting period after complying with the documentation, also you may have tax period more than or less than 12 months, not exactly same as 12 months. There is one more interesting question. We have two registered companies in Dubai, Company A and Company B, which did not form a tax group under corporate taxes. All of the employees are registered in Company A, but rendering services for Company B. Can Company A do the transfer pricing for staff working with Company B as far as wages is concerned, medical insurance, visa, and other employment expenses related to? I think this is a very classic case of many companies having this applicable in UAE. Employees are under Company A, but they are working for Company B. Maybe full all employees or some of the employees. So in which case, the expectation is that Company A ideally should be raising invoice onto Company B by covering all the expenses plus the ideal amount of margin to that. And what is the ideal amount of margin? That will be dependent on what kind of services the Company B is receiving. So those services are what category of services? Is it like services which are having no value addition to Company B's business, or do they have low value addition? In which case, 5% margin under safe harbor rules can be applied. But if those services are high margin, high value added, like those services are relating to core income generating activities of company B. So in those cases, you need to add necessary or sufficient amount of margins by following transfer pricing rules. You have to have benchmarking and done for those, and then charge the required amount of margin. This is what is expected to do. Do the firm need to pay taxes if revenue is below 3 million dirhams, but profits are above 375,000 dirhams? Girish.
So basically, if you are analyzing your small business relief eligibility, like I mentioned, it is irrespective of the quantum of your profits. If your revenue is within 3 million dirhams, the revenue, if you are earning from related party, it needs to be an arm's length revenue. If it is within 3 million dirhams, profits are above 375,000, that is not an issue. You can still claim small business relief and you're not required to pay taxes then,
Great.
subject to fulfilling small business relief conditions.
Yes. Yeah. There is another classic case asked by Dilipji. If the sales director is earning more than 1 million dirham from the company, but he is working under the management, but management never questions him for anything. He can hire and fire everyone, and he makes signatures for getting contracts and signs invoices. Will he be a connected person for company? He is not a relative of the shareholder. I think this is again in some of the SMEs, you can see these kind of scenarios. An individual who is not relative of the owner, but he still makes takes all the decisions of the company. He is the whole and soul of the company while running the business. He takes a salary. Whether that person becomes a connected person under corporate tax or not is the question. The answer is yes. If he is the person who is taking the decisions, he will be an officer who is significant, having significant influence on decision making of the company. Whatever payment is made by the company or benefits offered by the company to that individual, he is subject to this connected person's requirements. So you need to make sure that all those payments made to this individual are at market value, and you need to have necessary documentation to support your payments and demonstrate that they are at market value. Another important point is that along with corporate taxes, do we need to file signed copy of financial statements? Girish.
Yes, so basically, as we saw under small business relief, attaching the financials is optional. However, it is better that you have them ready in case the authorities ask. In all other cases, if it is a qualifying free zone person, audited financials mandatory. In all other cases, attaching the financials with the return is mandatory. You can alternatively give a reason for not attaching. However, in that case, FTA is definitely going to come back and ask you for the financials. And FTA expects you to give the financials which are signed and stamped. So they should be management signed and they should be stamped with the company seal. So
Yeah.
financials attaching is mandatory, except for small business relief cases.
Yeah. Even in small business relief case also, they may come back to you and ask you to submit certain additional documentation, which may include financial statements also, or trial balance at least. So how to find the market standards? How to do benchmarking? So I think it is one of the classic questions. The identifying market standards and working on benchmarking, it is not a straightforward activity to get. The data is not available across the table in the market as such. It requires some skill set to be able to come up with the relevant or appropriate documents or information related to your specific company, your size, and within the region. And based on that data or dump, you have to work around which becomes more suitable to your company with certain adjustments to it. That is when it becomes a benchmarking or pricing at arm's length. So we have a team of professionals who are continuously working on our expertise on this transfer pricing work. We can definitely help you in addressing that requirement, but it is not a straightforward thing to do. It requires special skill set to do and experience to address. There are various database selling companies depending upon the category of transaction. The different suppliers are available, our data providers are available. From there, we need to take it and then make necessary adjustments and perform all the kind of analysis that is required and make necessary documentation with respect to FAR, and then it becomes your document for transfer pricing. Can any correction to be made to the CT returns filing afterwards, Girish?
Yes,
Can
so
we?
like I briefly mentioned, you can amend your tax return by just changing your tax return. In that case, your return will be updated. However, this can be done only up to the due date of your tax return filing. If the due date of your tax return filing has passed, suppose 30th September was your due date, until 30th September you can amend it. Say you have filed it today, you can amend it again tomorrow and again day after tomorrow up to 30th September. Any change you want to do after the due date has passed, you will have to file a voluntary disclosure to make the corrections, and penalties would be levied in that case.
I think Dilipji's question is, how did you take the revenue for a trading company who is doing business in derivatives? They bought 5 million and sold 5 million options during the year, making a premium which is profit. Profit is 500,000. Will he be able to claim SBR benefits? How do you calculate revenue in this case? I think the important thing here to consider is what is your revenue? As per IFRS, what is your revenue? That is what is more important. If you're buying something and selling something, selling without holding them, so in which case the revenue becomes your commission or your profit. But if you are buying and taking the position, I think that is where we have to be very careful whether your total amount becomes your revenue, and then whatever you purchasing cost is going to be, that becomes your cost, and then balance is profit. So that difference will be there based on the way that you are conducting this trading activity. That is what I think. Girish, unless you have something else to add to this.
No, that's right.
Yeah. So the important point here to understand is that what is the revenue as per IFRS in your business model? That is what we have to understand first. Once we have clarity in that front, then based on that, whether your profit or whether your revenue is more than 3 million or less than 3 million will come in place. I think these are the questions that were asked in the chat box. Others are directly
In
answered
this
more or
case,
less.
basically, sir, in that question, since only revenue from operations is not covered, your gross receipt is covered. So highly
Yeah.
likely it will be considered as 5.5 million as your revenue, and SBR may not be available.
Yeah. That's what. So we just need to specifically see what kind of documentation do you have, which based on which we will have to derive what is your revenue as per IFRS standards. After which we will be able to see what is the revenue and then accordingly SBR or not. Yeah, so I think more or less we covered. There are many more which are not addressed. In the interest of time, we will be addressing them separately, or maybe we'll reach out to them directly. If you have any other questions, we are more than happy to answer you or provide you consulting as the case may be. Thank you all once again for attending this webinar, and we'll be conducting more and more in the coming days on various specific matters related to corporate taxes, accounting, audit, accounting, VAT, and other services. Thank you all once again, and good evening.
Thank you, everyone. Thank you for your time.